Hi guys, I'm Jamie. Now today we're going to be talking about unit trust and how it can affect your investments. Now if you're new, please subscribe. Also turn on your post notification. And if you found the video helpful, just please leave a like. We recently reached 1,000 subscribers, for which I'm very grateful. Now what I plan to do is actually release a thank you video next Monday on the Let's Start Money Day. Alright, so you guys can actually look out for that. Also, remember to hit the like button, cool? As you know, we're just getting started. I want to make sure that everybody in Jamaica have at least a little bit of financial understanding when it comes to stocks and the different types of investing out there. Because I'm sure a little bit of extra knowledge never hurt nobody yet. I remember guys, I'm on social media, so if you want to connect with me, you can find me on Twitter, Radcliffe2030, or you can find me on Instagram at Radcliffe. Now, if it is that you guys have any ideas for future videos that you would like for me to look into, just drop a comment below. You understand me? Alright, so into today's video, unit trust. A unit trust is pretty much a fund that invests in different asset types for the investors of the fund. It allows investors who would normally not be able to invest in certain asset types to pretty much own the assets without actually owning the assets in a sense. So what this means, guys, is that you're going to have a number of different type of unit trusts with different asset types and asset mix and so on. Now, when you're investing in a unit trust, what you need to know is you need to know the type of assets the trust is invested in to make sure that whatever it's invested in, it actually sits well with you. It's within your risk appetite and so on. Now, one thing, these unit trusts, they're normally open-ended. Now, what I mean by open-ended is that once you purchase more units, what the fund will basically do is to just increase exponentially. It will never close. So it's not like a company that is limited by stock. So once you have someone coming in that wants to purchase more units in the trust, they're just going to add more units. Now, when you're buying into a unit trust, what you do is you purchase the units at the NAV. Now, the NAV is the net asset value. Now, the NAV changes on a daily basis, right? Because the price of the assets in the unit trust is what actually drives the NAV. So if you have an asset going up, then what it's going to do is to bring the price of the NAV up. If it go down, then it will bring the price down also. In simple terms, NAV is calculated by dividing the value of the securities in the trust by the number of units that they have actually issued already. Now, get a simple calculation. Let's say you have 1,000 shares, right? And they cost $10 in a unit trust. And the unit trust has issued 10,000 units so far. What's going to happen is just divide 10,000 by 10,000, you're going to get 1. So the NAV right here would be 1. But the next thing we have to take into consideration, unit trusts don't only go by the assets in there, or liquid assets is also a part of it. You understand? So liquid assets like money. So you see if them actually have money on hand, it's also put into the calculation of the NAV. So let's say we have $500 in the bank account plus our 10,000 shares, our $10,000 share value, and our 10,000 units. Now, right now we have 10,500 because we have 10,000 shares and 500 in cash with 10,000 units out there. Now, when you divide this 10,500 by the number of units, you get $1.05. So this is how you see where the NAV actually moves. It moves based on the value of the security, the money that they have and all these things, and then you divide it by the number of units that they have issued so far. Now, even though I just use stocks to kind of give you an understanding of how the NAV is calculated, unit trusts don't invest only in stocks. They invest in bonds, they invest in real estate, they invest in a number of things. It just depends on the goal that unit trust is pursuing. And this is also one of the biggest reasons why you need to find out what the unit trust you're looking to invest in is actually invested in. Because I'm sure you don't want to invest in a unit trust when you are someone who very fearful of, for example, the stock market, because you have unit trusts that actually invest only in stock market instruments. Understand? So take that into consideration, people. When you invest in a unit trust, the first thing you want to do is to pretty much get the current price for the units of that fund. Now, normally, you can actually get the price out of the Gleaner or the Observer on a weekly basis, but here, by the time the price comes out in the newspaper, Yeah, price pretty much obsolete at that point in time. So what I would recommend is if you're going into a unit trust, go to the website for the company that offers the fund because they have to update these prices every day. You understand? I said price move every day, people. You also need to pay attention to who is managing your fund. Your fund manager is very important when you're deciding on a unit trust. You need to check their track record. You need to see what type of return their unit trust has been offering over the years. And next thing, depending on the type of unit trust you're going into, you might have to pay some taxes too. When you invest in unit trust, there are three tax types, so you need to take into consideration. First, you have the tax refund. Cool. This fund is fully tax free. No matter what, you won't pay tax on that. Then you have the tax refund that has special conditions applied to it. Then you have the taxable fund. Now, when you're looking at these funds, you normally see like little icons to denote them. So like for a tax refund, you might see like a little star. So so once you see the star, so these funds don't charge any taxes at all. And then for the other tax refund is a little circle. Now, as I said, this one with the circle is one where you have to actually get more information because it's not always tax free. You have to actually fill certain conditions. All right. Now, for the taxable fund, you normally get them with a little box. So once you see the box, you know that you're going to pay tax on that fund. Now, the fund that is denoted by the circle, the one with special conditions, what happens is that the government of Jamaica give you an opportunity to have your investment be tax-free, but this investment has to be there for 5 years. So you have to invest for 5 years in order to get the tax-free benefit. So how it works is that you're able to invest up to 1 million Jamaican dollar on a yearly basis for 5 years. That is tax-free. Now, if you invest 1 million in 2020, then you know say by about 2025 or 2026. Yeah. One of them here there. It's going to be tax-free. But guess what? It's the money where you invest in a 2021. It is not going to become tax-free the same time as the money we invest in a 2020. It will become tax-free the year after that. So it's basically a first in, first out kind of thing where your first 1 million become tax-free on the 5th year, while the second one become tax-free on the 6th year, and so on. And then you just continue up until whenever. Now, in everything, you have the good and the bad. You see, with unit trust investing, it is no different. One of the best things you can do for your unit trust investment is find a good fund manager. Best thing that you can do. With a good fund manager, you can expect better returns because you see them managers here, they're going to try to get you the best return possible. They're going to invest in the better asset classes that are going to give you better returns while still minimizing your risk and so on. They also have very, very well-funded research departments. One of the good things about having a big fund manager operating your investment, the research department is good. Now, as a little small investor, like for me, for example, when I'm doing my research, if I once misinterpret something, then me can probably lose. These people have like big research department, everybody going in doing this, and then they're going to collaborate and see if it is that what they're going to put your money in is right. They're not going to just make a one decision. So, as I say, that's one of the good things about unit trust that I want to shout for with we as smaller investors. And next thing, unit trust, just buy and hold. You don't have to worry about nothing. So unit trust is a passive type of investment. So you see, once you buy the fund, you don't really need to think about none. Unit trust normally is type of more of a medium to long-term investment also. So when you buy it, you just leave it there. Your fund manager, if you think about it, that's a for them problem. So they will need to think about what they're going to invest your money in, how they're going to make sure that the fund is turning profit. And remember, this work out for them. They have to think about that because if it is that if fund not turn profit and they not give good returns and so on, then nobody not really invest in it. When we invest in a stock market, we have to pretty much watch with investment. You have to always be there with it because here what? You see, one bad headline for your stock can tank the price. And next thing with unit trust, it give you the opportunity to diversify. So with the unit trust, it's not a case where one bad apple can spoil the bunch. Because everything pretty much will just smooth out in the grand scheme of things. By diversifying, what happens with unit trust is it will tend to also grow slow. So when you buy a stock and you see a stock doubling, and you know, see you get all of that the money there. With a unit trust, when them buy a stock and it double, it basically I go just try and make up for the stock them where I lose or the stock them where I give lackluster performance in the short term. So the whole thing smooth out at the end of the day, people. Now, as I said, with unit trust you give it diversify. Now, recently, Hertz. I don't know if everybody know about Hertz car rental, but they even have a branch here in Jamaica, so you probably hear about it. Hertz car rental filed for bankruptcy in the United States recently. Understand? And see right now, them stock worth like dollars so. Now, we are looking at a stock where in a February it trade for like $20 US. So if you did buy your stock in a February for that $20 US and you're still in a Hertz right now, your shares pretty much worthless. But you see, if you did in a unit trust and the unit trust is investing in a Hertz, then more than likely, you see the entire trust would have been able to take the hit from Hertz. But you as a small investor now go able to take that hit there with the one stock a plunge like $18 one time and you lose all of that money. You see me? So them are some of the good things about unit trust when them diversify them holdings. For me, one of the biggest disadvantage of a unit trust is the fact say, yo, you have to pay fees. Now, we all know it's enough free. Because unit trust, them have them big research team and them have to pay the managers to make sure say, oh, them do a good job and all of these things. So you can't free at the end of the day. People have to get paid. Me sure me and you now work for free. Can't expect people to work for free in that case here. Done. Or in any case, as a matter of fact. So you have to go pay fees for the person that manages your unit trust. Granted, you might not really even notice because the only time you're going to see your fees is when you're probably looking at their financials because the fee is always calculated in the NAV. So you just get the price at the NAV at all times. Now, them fee here, when you buy shares, you have to pay a brokerage fee. Unit trust not exempt from this brokerage fee. Them a buy shares, them still have to pay that brokerage fee, just like me or you. So them a pay these brokerage fees, and then we still have to pay them for them work. So it's kind of a double hit for full money, but as we said, you get the expertise. So it's really a risk reward trade-off. If you want to go at it yourself, then yes, you can pay less fees. Me personally, still not really a big fan of unit trust. I just feel like them grow too slow. That's one of my major thing with unit trust. Them just grow too slow. Because it's because them diversify so much, it causes the entire fund to pretty much go slowly. So you don't have that one stocks. Like when me would have makes a boom and like last IPO me going off a meal pack. Me buy my meal pack share say $1 and then it makes a bomb and $2 and me sell it and I don't say that a quick doubling of my money. You know, I really get that with a unit trust. So guys, these are just a few things about the unit trust where you can look into when you decide the type of investment where you want to go in. Now if you reach this far, go ahead and drop a comment on the video. Let me know if you like so far and think. You can also hit the like button. If you have any questions about the unit trust, just go ahead and drop them in the comments below. Be sure to respond to them as best as I can. Alright? Now again, if you like the video, hit that thumbs up. If you're not subscribed yet, just please subscribe. Turn on your post notification. And remember, once you do any form of investing, just consult your licensed, I'm going to say it again, licensed investment advisor before you make any change to your investing portfolio. Alright? Bye-bye.